Have you ever noticed that the biggest shifts in financial history rarely begin with a market rally? They begin with a vote, a policy decision, a quiet meeting behind closed doors where most people aren't paying attention. And today, the crypto market may be approaching one of those moments. The Clarity Act, a bill that has spent years trapped in Washington's political machinery, is now approaching what could become its defining test. At the very same time, the Federal Reserve is preparing another interest rate decision capable of reshaping global liquidity in a matter of minutes. Two completely different events, one focused on regulation, the other on monetary policy. But together, they could create one of the most important weeks XRP and the broader crypto industry has seen in years. Because while price charts attract attention, the real story is unfolding inside government buildings, regulatory agencies, and institutional boardrooms. And by the end of this video, you'll understand why many investors aren't just watching XRP's price. They're watching history unfold. See, for years, one of the biggest criticisms aimed at the American crypto industry hasn't been technology. It hasn't even been adoption. It's been uncertainty. Companies could build products. Developers could launch networks. Banks could explore blockchain. But nobody knew exactly where the regulatory boundaries were. That uncertainty became one of the largest barriers to institutional adoption. Imagine trying to build a skyscraper without knowing where the property lines actually are. That's essentially what many crypto firms have argued they've been doing. And that's where the Clarity Act enters the conversation. Its primary objective is straightforward. Create clearer rules defining how digital assets should be regulated, which agencies oversee them, and how companies can operate within an established legal framework. On paper, that sounds simple. In Washington, nothing is simple. Ladies and gentlemen, if you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel. I break it down simply so you can see what actually matters in the markets. Now, here's where it gets interesting. The legislation has evolved far beyond just another crypto bill. Supporters increasingly frame it as something much bigger: a jobs bill, an innovation bill, a consumer protection bill. Instead of arguing solely about Bitcoin, Ethereum, or XRP, supporters are talking about keeping technology companies inside the United States, protecting financial innovation, maintaining competitiveness against Europe, Asia, and the Middle East. That's an important shift, because political narratives often matter just as much as policy details. When lawmakers debate cryptocurrency alone, opinions become divided. When lawmakers debate jobs, investment, and technological leadership, the audience becomes much more broader. That's one reason why more than 1,200 technology companies, alongside major financial institutions, including Fidelity, Goldman Sachs, have reportedly backed the broader push for regulatory clarity. This isn't just crypto asking for crypto rules anymore. Large institutions increasingly want certainty before committing even larger amounts of capital, and that changes the political equation dramatically. But despite years of discussion, the Senate remains the biggest obstacle. Unlike the House of Representatives, where bipartisan support has been easier to assemble, Senate rules create a much higher hurdle. Most significant legislation requires 60 votes to overcome a filibuster. That means simple majorities often aren't enough. According to reports surrounding the current negotiations, Republican leadership believe it has roughly 51 reliable votes, while reaching 60 requires Democratic support. And that's where negotiations have become increasingly complicated. Several Democratic senators have reportedly indicated they are not outright opposed to the legislation. Instead, they want stronger safeguards, more consumer protection, additional anti-money laundering provisions, greater enforcement mechanisms, especially after the collapse of major crypto firms over the past several years. From their perspective, clearer rules should also mean stronger protections. That's become one of the central negotiating points. Let this sink in. Now, this is what most people miss, unfortunately. Political negotiations rarely happen because everyone disagrees. More often, they happen because everyone agrees on the destination, but not the road leading there. Many lawmakers acknowledge that digital assets aren't disappearing. Institutional interest continues growing. Global adoption continues expanding. The debate increasingly revolves around how the industry should be supervised, not whether it should exist. That's an important distinction, because markets often react to headlines, while institutions focus on long-term regulatory direction, short-term noise, long-term structure. That phrase has never been more relevant. History offers an interesting lesson here. During the Industrial Revolution, governments across Europe and North America struggled to regulate railroads. At first, railroads networks expanded faster than lawmakers could understand them. Different companies built incomparable systems. Rules varied between regions. Investors faced enormous uncertainty. But once governments established common standards, investment accelerated dramatically. Railroads didn't become successful because regulation disappeared. They became successful because clearer rules reduced uncertainty. That same principle may apply to digital assets today. Markets don't necessarily require less regulation. They often require better regulation. That's an important difference. Meanwhile, Ripple appears to be preparing as federal regulatory clarity is eventually coming, regardless of exactly when. Rather than waiting on politicians, the company has continued investing in institutional infrastructure. Ripple has expanded compliance capabilities, developed enterprise-grade blockchain tools, and continued building products designed for financial institutions rather than retail speculation. One example, attracting attention, is Ripple's institutional infrastructure initiatives, including Ripple Mint and broader compliance-forced services. The company's stablecoin ecosystem has also continued expanding, with growing market participation, attracting attention across institutional circles. Whether legislation arrives this month, later this year, or further into the future, Ripple seems determined to ensure its infrastructure is already in place. That's a fundamentally different strategy from relying on favorable legislation alone. Let that sink in. Instead of saying, we build after regulations, the company appears to be saying, we'll be ready before regulations. But here's where the story becomes even more fascinating, because legislation isn't the only catalyst approaching. The Federal Reserve is preparing another policy decision, and global markets know exactly how powerful Fed announcements can be. Interest rates influence borrowing costs, government bond yields, corporate financing, mortgage rates, liquidity, investor risk appetite. Virtually every financial market feels the impact. Crypto is no exception. If policymakers adopt a more hawkish tone, investors sometimes become more cautious toward higher risk assets. If markets interpret the message as more accommodative, risk appetite can improve. Nothing is guaranteed, but historically, consistency shows monetary policy influences financial conditions far beyond traditional banking. Now, here's where everything begins connecting. Imagine these two events unfolding simultaneously. One potentially delivers greater regulatory certainty, the other influences global liquidity. One affects confidence in the legal framework, the other affects available capital. Those aren't isolated developments. They're interconnecting forces. That's why some analysts have described this period as a potential double catalyst. Not because either event guarantees higher prices, but because both influence investor behavior from completely different directions. Prices reacting, the system's evolving. Those are not always the same things, ladies and gentlemen. Political observers are also paying attention for another reason. Election cycles change incentives. Lawmakers increasingly understand that millions of Americans now own digital assets in one form or another. Crypto is no longer a niche technology followed only by developers and early adopters. It's become part of retirement accounts, investment portfolios, corporate treasury discussions, university research, payment innovation, and increasingly national economic strategy. That changes how politicians approach the conversation. Every vote becomes more visible. Every public position becomes easy for votes to remember. If Senate leadership ultimately forces a vote before every negotiation is complete, lawmakers may be required to publicly declare where they stand. See, supporters argue that creates accountability. Critics argue it could harden political divisions. Either way, public votes are difficult to ignore. See, history provides another remarkable example. In 1999, the United States passed the Gramm-Leach-Bliley Act, removing barriers that had separated commercial banking, investment banking, and insurance for decades. Whether one agrees with every consequence of that legislation or not, one fact remains undeniable. A change in the legal framework fundamentally reshaped the financial industry. Entire business models emerged because regulation changed. Capital flowed differently. Institutions reorganized themselves. Innovation accelerated in some areas while new risks emerged in others. The lesson isn't that every regulatory change produces positive outcomes. The lesson is that the legal framework shaped markets far more than most investors realize. Technology evolves, but institutions move when things change and rules change. And today, many investors believe digital assets may be approaching another regulatory crossroad. But legislation alone doesn't determine whether an industry succeeds. History has shown us that over and over again. Rules can create opportunity, but companies still have to execute. And that's exactly why Ripple's recent strategy deserves attention. Rather than focusing exclusively on courtroom victories or political headlines, the company has steadily expanded what many describe as an institutional-grade infrastructure. That may not generate the same excitement as a dramatic price spike, but for banks, Payment providers and financial institutions, infrastructure is often far more important than hype. Think about it. Large institutions don't move billions based on social media sentiment. They move when they have compliance tools, reliable settlement systems, risk management, clear reporting standards, and technology that integrates with existing financial infrastructure is so important. Ripple appears to be positioning itself around that reality. If regulatory clarity improves, the company may already have much of the operational framework needed to serve institutional demand. If regulation takes longer than expected, those investments don't simply disappear. They continue building long-term capability. That's a strategy focused less on today's headlines and more on tomorrow's financial system. Now, this is what most people miss. Many investors become so focused on whether a bill passes this week or next month that they overlook the bigger structural trend. Institutional adoption isn't driving or driven by one single event, ladies and gentlemen. Let this sink in. This is so important. It's driven by layers of confidence. First comes technology, then infrastructure, then regulation, then capital allocation. Each layer reinforces the next. That's why the current moments feel so significant. The Clarity Act isn't being viewed in isolation. It's being evaluated alongside everything else that's been happening across digital assets over the last several years, from stablecoins to tokenized assets to blockchain-based payments to growing institutional experimentation. The conversation has evolved far beyond speculative trading. Increasingly, it's become a discussion about financial infrastructure, and that changes the audience completely, ladies and gentlemen. See, one of the strongest arguments made by supporters of regulatory clarity is that uncertainty carries its own cost. When businesses don't know which rules apply, many simply delay investment. Developers move overseas. Capital looks elsewhere. Innovation slows. That's why so many technology firms have joined the conversation. For them, predictable regulation isn't simply about crypto. It's about planning, hiring, building, and competing globally. Supporters argue that the United States risks losing talent if uncertainty continues. Critics respond that moving too quickly could leave consumers exposed if safeguards aren't strong enough. Those two positions aren't necessarily incompatible, but both recognize that digital assets are becoming increasingly important. The disagreement lies in how quickly the legal framework should evolve. But here's where it gets very interesting and spicy. Markets rarely wait for perfect certainty. Investors constantly price probabilities, not guarantees. If market participants begin believing regulatory clarity is becoming more likely, prices can react before legislation is officially signed. Likewise, if negotiations appear stalled, markets may become cautious, even if the long-term outlook remains unchanged. That's why volatility often increases around major political events. Expectations shift long before outcomes become official. And once decision finally arrives, markets begin analyzing the next question almost immediately. The story never truly ends, ladies and gentlemen. It simply evolves. Consider this historical analogy. The Clarity Act is a bit like constructing a modern harbor. Ships may already exist. Trade may already be happening. But without clearly marked channels, navigation remains slower, more expensive, and more uncertain. Building the harbor doesn't create the ocean. It creates confidence in using it. In much the same way, regulatory clarity doesn't create blockchain technology. It creates a more predictable environment for institutions deciding whether to participate. That's why many analysts believe the discussion extends far beyond XRP. It's really about whether digital assets become integrated into mainstream finance over the coming decade. At the same time, the Federal Reserve remains impossible to ignore. Every statement from the central bank is examined word by word, not just by traders, but by banks, asset managers, governments, and multinational corporations. A more hawkish tone could encourage investors to remain defensive. Higher borrowing costs generally reduce liquidity across financial markets. On the other hand, a more dovish message could improve overall risk sentiment. That doesn't automatically mean crypto rallies, but liquidity has always been one of the most powerful forces influencing market behavior. When money becomes easy to deploy, risk assets often benefit. When financial conditions tighten, investors tend to become more selective. The interaction between monetary policy and regulatory developments is precisely why so many market participants are watching this period so closely. Now, this is where perspective becomes essential. It's easy to become consumed by our headlines. One senator makes a statement, markets react. Another official responds, prices move again. But structural transformation usually unfolds over years, not days. Think about how long the internet took to become a foundation of everyday life, or how electronic payments gradually replaced cash transactions. Major technological transitions rarely follow straight lines. They advance, pause, face resistance, then continue moving forward. Crypto appears to be following a similar pattern. The journey has included innovation, speculation, failures, regulatory disputes, and increasingly institutional participation. Each stage has reshaped the conversation. Here's another historical analogy. Imagine medieval builders constructing a massive stone cathedral. For years, outsiders may have looked at the unfinished structure and concluded nothing meaningful was happening. Scaffolding surrounded everything. Construction seemed painfully slow. Progress appeared invisible. But beneath that scaffolding, workers were laying foundations designed to support something lasting. Today's regulatory process can feel remarkably similar. From the outside, negotiations seem frustrating. Votes get delayed. Amendments appear. Political disagreements dominate headlines. Yet beneath all of that, governments are gradually defining how digital assets could fit into a broader financial system. The process isn't glamorous. It's actually very boring. It's like watching paint dry on the wall. But foundations rarely are. For XRP specifically, the implications extend beyond price speculation. Greater regulatory clarity could reduce uncertainty surrounding institutional participation. Banks evaluating blockchain payment solutions generally prefer legal certainty before making significant commitments. Payment providers seek predictable compliance requirements. Financial institutions value consistency. That doesn't mean adoption happens overnight. It doesn't, no. Nor does it guarantee that every institution chooses the same technology. Competition will remain intense. Innovation will continue. But clearer rules may allow businesses to compete based more on capability than regulatory ambiguity. And that's an important distinction. Supporters of the legislation also argue that consumer protection doesn't have to conflict with innovation. In fact, many believe effective regulation can strengthen trust. After all, confidence has always been one of the finance's most valuable assets. People deposit money because they trust banks, ladies and gentlemen. Invest in markets because they trust legal systems. Use payment networks because they trust settlement mechanisms. Trust reduces friction, and reducing friction often encourages participation. That's one reason several senators have reportedly continued pushing for stronger consumer safeguards during negotiations. Whether those provisions ultimately change the final legislation remains uncertain. But the discussion itself highlights how the industry has matured. The debate is no longer whether digital assets exist. It's increasingly about how they should operate within established financial systems. So where does all this leave investors? Perhaps one simple reminder: separate short-term emotion from long-term structure. A single vote won't determine the future of blockchain technology, nor will one Federal Reserve meeting. But together, these events could influence sentiment, liquidity, and regulatory expectations at the same time. That's why this moment feels unusually important. Not because anyone can predict the exact market reaction, but because multiple structural forces are converging simultaneously. And markets tend to pay attention when that happens. Short-term noise, long-term structure, prices reacting, systems evolving. Pay attention to what's quiet, ladies and gentlemen. Those ideas remain just as relevant today as they've ever been. The next several days could become one of the most closely watched periods for the crypto industry this year. The Senate advances the legislation, investors will begin evaluating how quickly regulatory implementation could follow. If negotiations continue, attention may shift towards future amendments and bipartisan compromise. Either outcome provides new information. At the same time, markets will continue digesting every word from the Federal Reserve, balancing expectations around inflation, interest rates, and economic growth. None of these developments exist in isolation. Together, they help shape the environment in which innovation, investment, and adoption take place. Whether you're following XRP, the broader crypto market, or simply the evolution of global finance, this is a story worth watching carefully, because the biggest challenges often don't begin with explosive price charts. They begin with shifts in policy, in institutions, and in the rules that define how financial systems operate. And those are exactly the kind of words and changes unfolding right now. If reported legislation timelines hold, the coming days may offer greater clarity, not just for XRP, but for the direction of digital assets in the United States. The headlines will come and go. The volatility may continue, but the larger questions remain unchanged. How will the financial system of the future be built? The answer is still being written, and we're watching it happen in real time. If you've enjoyed this breakdown and want more in-depth analysis connecting macroeconomics, regulation, the future of digital assets, make sure to subscribe to the channel and turn on notifications. Because in markets like these, understanding the bigger picture is more valuable than simply chasing the next headline. Thank you for watching. I'll see you in the next video. Hope everyone's having a blessed morning. I want to welcome all the new members of the Patreon, the Crypto Public Desk Monthly, and all the new members of the membership channel. It's going to be very interesting to see what happens this afternoon when the Federal Reserve meets. This video was recorded before the meeting. Ladies and gentlemen, the chaos that's going to follow will probably be immense one way or another. We were going over a bunch of things on the Zoom call that could potentially see what the Fed may or may not do and how markets will react. But if you want to learn how to trade and invest in environments like this, come and join the Crypto Public Desk Monthly and join over 630 active traders and investors who are taking their destiny into their own hand. One solid tips from the pits can pay for your entire year subscription. Our members in the last act of the chaos in the Middle East made between 50 and 150% on their money, depending on what tips from the pits they decided to take. This is not financial advice, ladies and gentlemen, just my own opinion. I think no matter what happens this afternoon, the market's going to be disappointed on one hand, and it will paint a clearer picture. We're still long the metals, silver, Bitcoin, and gold. We like silver very much, and it's going to be interesting to see what happens. But with the kinetic action starting to heat up, nothing has changed. So we're following the big king daddy dollar, DXY, to where we're going with this. But again, ladies and gentlemen, the chaos that is brought allows financial mercenaries to make better decisions because it clears the way out of uncertainty. Because if we know what's happening and why, we know what to trade and what to invest and how to position. None of this is financial advice, just my opinion, everything's in the capacity. But if you want to learn how to trade, you want to learn how to invest, come and join the Crypto Public Desk Monthly. Again, our members saw amazing returns during the first act of the chaos in the Middle East. One solid tip for the pits pays for your entire year subscription, ladies and gentlemen. With that being said, let's enjoy interest rate day. I love you all, ladies and gentlemen. I'll see you on the front lines. These videos are made for educational and entertainment purposes only. This is not financial advice ever. Always consult your licensed financial advisor before making any investment decisions. Never invest any money or any capital ever from watching a YouTube video. Don't ever invest money from watching a YouTube video ever. Don't ever do that. I love you all, ladies and gentlemen. I'll see you on the front lines.